Hello viewers, welcome back to Web Educate. In this video, we are going to explore statements of consolidated financial position under group accounts. Consolidation means when when the parent company acquires subsidiary company, then the two of them come together and they become one. Before the acquisition, the two companies have a separate financial statement. But when the acquisition takes place, the financial statement of the parent and financial statement of the subsidiary will be merged together. That's what we call consolidation. Instead of the two companies to present two separate accounts after the consolidation, they present only one account. That's means consolidation. They consolidate their financial statement. But in this video, we are going to cover the balance sheet aspect of it, and that is what we call statement of consolidated financial position, where a parent company acquires the net asset or the ordinary shares of the subsidiary company. So when the parent company acquires, it's going to present subsidiary company is going to present a single account. So in this video, we are going to break down a situation when parent company acquire acquire 100% of the ordinary share of the subsidiary. Excuse me. What is the meaning of this? That means in this case, when parent company acquire 100% of the ordinary share of the subsidiary company, that means it acquires all the shares of what? Of the subsidiary. That means there is no non-controlling interest. That means the parent company will be controlling all the shares, because parent company acquire 100%. There are cases where parent company acquire less than 100%. It may acquire 80%, it may acquire 70%, it may acquire 60%. But for a parent company to have a control over the subsidiary company, that means it must acquire more than 50%, that is 51% and above. But in this particular case that we are going to explore today, that we are going to break down, parent company acquire 100% of the ordinary share. That means there is no non-controlling interest. Number 2, acquisition gave rise to negative goodwill. Give rise to negative goodwill. What is the meaning of negative goodwill? The meaning of negative goodwill is that parent company acquire the subsidiary company's ordinary share or net asset. The worth of the subsidiary company, the amount the parent company pay is less than the worth of the subsidiary company. For example, let's assume that net assets of the subsidiary is, let's say this dollar sign is $500. Then the purchase, what is the net asset? Net asset is, in our previous video we talked about accounting equation. Accounting equation. What accounting equation? Accounting equation is a asset equal capital or equity. Capital plus liability. The net asset is that this is the total asset. Net asset is that when liability is deducted from assets. You know, capital plus liability equals asset. Assume asset equal 10, right? And liability equal 3. What we get here is what? Is net asset. Assuming this is 7. Then if we add 7 plus this, that give us 10. But what is now net asset? Net asset in this scenario, net assets equal, we're going to make capital is now the net asset, that is a capital or shares. That is net asset. This capital includes equity, share premium, retained earning, surplus reserve, and so on and so forth. So, if we are talking about net asset, it means that you make capital or equity, make it the subject of the formula. That means our capital, which is 7 now, equal assets. Equal assets, which is 10, minus, what is liability? Minus liability. And our liabilities is what? Is 3. That means net asset is now what? Asset, which is 10 here, minus liability, that gives us 7. So net asset here is equal to what? Equal 7. So net asset is when we deduct the liability from asset, what is left over is net asset. For example, like what we gave here, assuming net asset what is 500. So then the purchase consideration. Purchase consideration. What is not purchase consideration? Is the amount that the parent company pays to acquire the subsidiary company. So purchase consideration. Purchase consideration. Let's assume that this is 300. This is negative. Negative goodwill. Look at it. This is the amount paid to acquire this. Tell me the amount paid to acquire subsidiary is less. So what we have what is a negative. Assume that this is 700. The goodwill is, assume that this is 800. The goodwill is going to be 300. But in this case, this is what? The amount paid to acquire the subsidiary is what? Is lesser. This is what you call what? Negative goodwill. You have to bracket it. That shows what? That shows negative. What are the possible reasons for this? The possible reasons may be it may be that the subsidiary company is not performing well, or it may be that the parent company does not consider its performance. It may just maybe possible reason for parent company to acquire the subsidiary company less than its value. Maybe the parent company have interest in what? In the activity of the subsidiary. It may be maybe because of the raw material. Maybe the subsidiary company is producing raw material that the parent company needed. Maybe because of that to acquire the subsidiary company without considering the profitability of the what? Of the subsidiary company. So it may be, maybe another reason may be maybe because of the management performance of the subsidiary. Maybe because of the personnel management of the subsidiary. Maybe he has a good management. So because of that, parent company may want to bring the management of the subsidiary into his company, bring them on board so that the management can carry out the activity of the managing company very well, so that they be able to perform well. There are a lot of reasons. So the parent company will not consider whether there is a negative goodwill or not. You go ahead and what? And merge together with the subsidiary company. But when this happens, this is not always the cases. No company will want to acquire a company that is not performing. But when this happens, the requirement of the IFRS is that calculation, it may be that maybe because of an error. So the position of the IFRS is that the calculation should be repeated. Maybe there is an error. So if the calculation was repeated, if there is no error, that means that is the position of what? Of the subsidiary. So in that case, we call it goodwill. Goodwill is an asset. So when it happens this way, negative goodwill, it will not be treated as an asset. It will be treated as income. So it will be added to the parent company retained earning. So that's what we are going to cover in this video. 1. When parent company acquire 100% of the ordinary shares of subsidiary. 2. Parent company acquisition of the subsidiary gave rise to negative goodwill. When it happened, to be treated as an income, not as an asset. What we are still going to cover today is, in this video, which is the third, when the acquisition takes place the same day, the date of acquisition takes place the same date the consolidation takes place. That is, date of acquisition equal date of consolidation. Date of acquisition takes place the same way with date of consolidation. What is the effect of this? When acquisition and consolidation takes place the same day, it means that the day the consolidation, that is that the group is presenting is a statement of consolidated financial position. That is the day they are preparing their balance sheet. It's the same day they acquire the company. The effect of this is that no profit has been made. No profit has been made because there is no way they can make profit in one day. How can a company acquire another company and they started making business activity or transaction in just one day and make profit? No. Before they can make profit, they will have been carry on business activity for like 6 months, 1 year. For example, if acquisition takes place by January and consolidation takes place by December, that means 12 months. So they must have made profits then. So in this case, it is only pre-acquisition retained earning that takes place. Only pre-acquisition, only pre-acquisition retained earning. Only pre-acquisition retained earning will arise. There will be no what? There will be no post-acquisition. Only, that means no post-acquisition, retained earning. That's the effect of it. When acquisition or when consolidation takes place the same day with acquisition, no post-acquisition. That means it is only the profit that the subsidiary company has. Only the profit that the subsidiary company have before the acquisition is what the parent company is what the group company have, what they are going to consolidate, because they can't consolidate post-acquisition retained because they have not made profit, they have not made any business transaction. So it means that there will be no what post-acquisition retained, but there will be what pre-acquisition retained earning. So that's what we are going to break down today in today's video. So I'm going to write the question, and we are going to solve it accordingly. Again, parent company account 100% of the ordinary shares of the subsidiary company. That means there is no controlling interest. 2. Acquisition gave rise to negative goodwill. That means the goodwill will not be treated as asset, to be treated as income. Then the income will be added to what? Consolidated retained earning of the parent company. So, 3rd, acquisition takes place the same date the consolidation takes place. That means there is no what? No post-acquisition retained earning. It's only pre-acquisition retained earning that will arise during the consolidation. Question. Tola PSC acquired 100% of the ordinary shares of Collar PSC on 31st May 2022. When the retained earning of Collar PSC was $700,000. The following is the statement of financial position. The following is the statement of financial position of the two companies. And I have it here. I have Collar PSC and I have Collar PSC. $sign. So I have non-current assets. Because non-current let's say I have assets. Assets is first in the classification of balance sheet. Asset is the first. Then you have a non-current assets. Non-current asset for the parent company, which is Tola, we have 1,800,000. For Collar, we have 700,000. Investment. Investment in Collar PSC. This only appear in the parent company. 1,550,000. Then, what's not this? That is the amount that the parent company used to acquire the net asset of the subsidiary, which is Collar. Then we have a current assets. Under the asset, we have non-current assets. Then we have current assets. We have current assets, which are inventory, and under the parent we have $950,000 Under subsidiary, you have $800,000. Then we have trade receivable. Trade receivable. We have $1,400,000. Then under subsidiary, you have $1,300,000. Then we have bank. We have bank 1,300,000. Then we have under subsidiary, you have 1,150,000. Then you add up. This is total of the asset. You add up or you round up. So what is total? If you use calculator, this gives me 7 million, and for the subsidiary it gives me 3,950,000. Okay, we go to the next classification, which is equity and the liabilities, and that is we have what? Equity share of 50 cents, because we are talking in terms of dollar here, of 50 cents each. And what is the amount for the parent? We have $800,000. For the subsidiary, we have $400,000. For the share premium, parent company, we have $600,000. We have then for retained earning, and you add it up, this gives me 4,150,000, and this gives me $1,700,000. We call it equity. Look at it. This is a asset, and this is a equity and liability. Asset equal equity plus liabilities. So this is the equity, these are the assets, then I'm going to have liabilities. So the equity, then I have liabilities. This is total assets. Sorry, this is total equity. Total equity. Then this is what? This is the liabilities. These are the liabilities. You have a current, non-current liabilities. And that is a 15% loan notes. Excuse me. For the parent, that is a $1 million for subsidiary, $800,000. Then you have current liabilities. Current liabilities. Then we have trade payable. Then we have let me just write it together. Bank overdraft. Then for the trade payables, and for the bank overdraft, trade payables I have $1,150,000. That's for the parent company. For subsidiary, $1,150,000. Then for the bank overdraft, subsidiary, parent company, I'm having $600,000. Then for the subsidiary, $300,000. And when we add it up here, sorry for the space, this gives $7 million. Why this also gives $3,950,000. Look at it. Assets should be equal equity plus liabilities. That gives us $7 million here, $3,950,000, $7 million. So that is that about the question. So we are now going to solve it. We are going to solve it. This is the question. Tola PLC acquired 100% of the ordinary share of Kola PLC on 31st May 2022, when the retained earning of Kola PLC was $700,000. The following is the statement of financial position of the two companies. An error here. Statement of financial position. Financial position of the two companies. And these are the two companies, Tola and Kola PLC. This is the asset, equity and liability. So I rub off to present the solution. So first, on the item for the solution, you present the what? The workings. And working number one is group structure. So what is the group structure? That is, group structure is what? Is the diagram that show the percentage of the acquisition. Diagram that shows the percentage of acquisition. And what is the percentage? What is the acquisition? How does acquisition take place? Color PSC. Color PSC acquire. This arrow shows. This arrow navigate to. This is color. Sorry. Color PSC acquire 100%. 100%. Tola acquire 100% of color PSC. What date? The date is the date here is the date here is and what is that date? Say Tola PSC acquire 100% of the ordinary share of Color PSC on 31st May. May. 2022. Well, there is one omission in that question. Say the following is the statement of financial position on the same date, 31st May 2022. So that means the date of acquisition is the same date. Because the date of financial statement is still 31st. Is this same date, 31st May 2022, which was omitted in that question. When you are reading the question, take note. The statement that said the following is the statement of financial position of the two companies. There is no date there. But after the two companies are supposed to be what? On 31st May 2022. Date of acquisition is 31st May 2022 there. But in the date, there is no word, there is no 31st May 2022 in the statement of financial position. So note that there is a date there. So there is a date there. The date of balance sheet is 31st May. The date they acquire the company is still the same day, 31st May 2022. This is the percentage of acquisition, 100%. And what is the meaning of this? That means there is no what? No. Let me just write it so that there is no non-controlling interest. This is the implication of this. Because when you purchase 100%, that means parent company is controlling the Tola is controlling Color entirely. There is no any interest left over for other shareholders outside afterwards to control. So Tola is controlling Color PSC 100% entirely. So that is that. Then number two work is is a capital and reserve. Capital and reserve, that is net assets. Net assets of the subsidiary. And what do you have under that? One, you first of all have date of acquisition, you have date of consolidation, then you have post acquisition retained earning. Under here, we may also have maybe difference between the share, ordinary share at date of acquisition and date of consolidation. If there is issue of shares, there might be excess of share from the date of acquisition to what? Date of consolidation. Also, there might be excess of share premium from date of acquisition to date of consolidation, which will come under this column. But in this case, there is no issue of shares. What we have here is just the ordinary share, acquisition of ordinary share. So what do you have under here? You have here dollar sign, dollar sign, dollar sign. So we have first on the item here, or first on the line here is what? Is share capital. Share capital or equity. Just put it equity. Or let's put this share capital for it to do what? Ordinary share. Ordinary share, which is, in this case, it is only, look at it, we call it subsidiary. Capital and reserve, that is net asset of the subsidiary. In this case, we only go to the statement of financial position. We now go to the column of the color PS, which is the subsidiary. Here, color is subsidiary in brackets. Color, we go to column of what? Of color. And what is the equity share of color there? That is a $400,000. Sorry, $400. $400,000. And on date of consolidation, since there is no issue of shares, it remains the same. It remains. So there can be only difference if on the date of consolidation there is issue of shares, which can increase this value to be greater than 400, but there is no. So the 400 still remain $400,000. So you have a share premium on the same column of color PSC, which is a $600,000. And since there is no issue of shares, it still remains the same here. No difference. So we have a retained earning. Retained earning, which is also 700. The date of acquisition is what? Is 700. So and look at it. Date of acquisition. Look at it. 31st May. 31/5/2022. Date of consolidation. 31/5/2022. The same date. And that's why I said the balance sheet date. 31st. That's what I said is an omission there. That's supposed to be 31/5/2022. So, and the date of acquisition, see, Color PSC acquire 100% of the ordinary share of Color PSC on 31st. That is date of acquisition in the question. Then the balance sheet date say the following in the question also. The following is the statement of the financial position of the two companies on 31st May 2022. So 31st May 2022 was omitted there. So this is the figure there. This is the date there. That means it's the same date. On this date, they have not made. How can they make profit on one day? That means there's no. So it should remain 700. So there's no post-acquisition retaining. Post-acquisition retaining is nil. It's nil. That's just the implication of what I've just been explaining. So what is the net asset here? If we add it together, it gives us 1,700,000. Here also 1,700,000. If there is a if the data are not the same, we are going to have what? Difference. So there is no difference. So that's the working 2. Working 3 is goodwill. Working 3, calculation of goodwill. So you have the dollar sign. That dollar sign. And what's the, you have the cost of investment. Cost of the investment. What do you have here? Cost of investment. What do you have here? In the question, in the balance sheet of the Dollar PLC, say investment in Dollar PLC 1,550,000. Investment in Dollar PLC under the Dollar PLC column of the statement of financial position. So what do you have? We have 1,550,000. So you add non-controlling interest. Because Dollar PLC acquire 100% of Dollar PLC, that means there is no non-controlling interest. And non-controlling interest is what? Is nil. Is what is nil. 100% share acquired. So what we have here is what? Nil. So there's nothing I added because 100% was acquired. In bracket, 100% share. Let me use SH as share. Acquired. That means there's no non-controlling interest. Non-controlling interest what is nil. So if I add this up, it still give me 1,550,000. So I will now go ahead and less net assets of the subsidiary at the date of acquisition. DOA means date of acquisition. DOA, date of acquisition. DOC, date of consolidation. Right? So what is the net asset of the subsidiary at the date of acquisition? 1,700,000. 1,000,000 1,700,000. So you less net assets of the subsidiary from the purchase. This is purchase consideration. Purchase consideration. purchase consideration. So, purchase consideration means what? The amount that the parent company used to acquire the net asset of the subsidiary. What is net asset of the subsidiary? That's 1,700,000, which I say it will give rise to negative goodwill. Ordinarily, this figure is supposed to be higher than this. This amount to use to purchase, and this is what they are purchasing. How could the figure they are purchasing is higher than what the figure they used to purchase it? That means negative goodwill. And this is what the difference is a 150,000 dollars. So this is negative. This is negative goodwill. Negative goodwill. This is negative or negative goodwill. And if it's negative goodwill, you do what? You bracket it. You bracket. It means it's negative. If this figure is higher than this, give us positive goodwill. So in this case, what is the position of the IFRS? Position of the IFRS is that this ordinarily goodwill should be treated as an asset if it is positive goodwill. But since the net asset is higher than what the purchase consideration, it will be treated as profit. It will be treated as what? As profit. It will be added to what? Retained earning of the what? Of the parent company when consolidated. So this is a working one, group structure, working two, capital and reserve, working three, calculation of goodwill. So for the working four, which is a calculation of what? Consolidated retained earning. Calculation of consolidated retained earning. I'm going to rub off this part for me to allow me write the calculation of consolidated retained earning. So this is working four. This is working four. Working number 4, calculation of consolidated retained earning. Then you have the dollar sign here. You have the dollar sign. And what's the first one, the item? That is the parent company retained earning, right? And what's the amount there? The amount here is, when we are calculating capital reserve of subsidiary, we go to the column of what? Of the color PS, which is subsidiary, under the balance sheet. In this calculation of consolidated retained earning, this only the retained earning of what? Of the parent company, which is the company, which is the parent company. So what is the equity? What is the retained earning of the parent company? That is a 2 million. If you go to the balance sheet there, or the statement of financial position, then it is $2,750,000. So you add share, add parent company share, add parent company share of post acquisition retained earning retained earning from subsidiary company. From subsidiary. So there is no post-acquisition retaining. Like this is what I said here. This is supposed to be post-acquisition retained earning. But since the date of acquisition is the same date, they have not made any business activities. So there is no post-acquisition retaining. It's only pre-acquisition retaining that we have. This is pre-acquisition retaining of what? Of the subsidiary. This is 700. Yeah, and it still remains the same on date of consolidation. So there is no difference. So there is no post-acquisition retaining. Since the same date is what? The date of what? Acquisition and retaining. That means there is going to be what? There is going to be nil. So addition still give us back $2,750,000. So let me rub off this place. From the position of the IFRS, which we said that the negative goodwill here will be added to retain earning of what? Of the parent company. So negative goodwill ordinarily supposed to be added to what? To the added to the assets under the balance sheet, which is financial position. But because it is a negative goodwill, so it will be added. Add negative goodwill. Negative goodwill, and that is what? That is a 150. And that gave me $2,900,000. So that's the end of the workings. So we're now going to present. We're going to present the consolidated statement of financial position. Now, so these are the workings. You have working 1, group structure. Working 2, capital reserve of the subsidiary. Then we have working 3, goodwill. And this working 4, calculation of consolidated retained earning. These 4 workings are the workings that the figures that we use in the what? In the balance sheet that we use to what? To complement the figures that we have in the consolidated financial position. Other figure will be picking, like the current and non-current assets will be added together. Also, current asset figures will be added together. No transaction affected them, so it remain the same. Add the parent to the subsidiary, non-current assets, add it together. Current assets, inventory, receivable, bank, add it together, become one. Then you go to share, equity shares, only equity shares. You are not adding equity shares. It's only equity share of parent company that we take to work to balance sheet, and also its share premium. Why this consolidated? This is a figure of what? Of the share, equity share of the parent company. But we still add the negative goodwill because it's what is an income. We add it to the retained earning of what? Of the parent company. So we add it together. So this is the figure that we use in the consolidated statement of consolidated financial position for the retained earning. But the rest equity, like this ordinary share and share premium, will be taken directly from what? From the balance sheet. But because we have make adjustment to the retained earning, this is what I will use instead of using this figure as what? For the parent company in the statement of consolidated financial position. That clear? So I rub off to present it now. So also, when you get to liabilities, we add non-current liabilities together. Parent and subsidiary become one. That's the meaning of consolidation. We had non-current. We also have we add non-current asset. Sorry, we add non-current liability. We also add current liability together. As that we are consolidating them, it becomes one. So I rub off to present the statement of consolidated financial position. So if you are an existing subscriber, don't forget to share our videos. And if you are a new subscriber, you are new to our channel, you have been deriving values all along. Do share our video and subscribe to our video so that when we produce more of this, subsequently, that is in the future, YouTube algorithm will be able to notify you when more value like this is uploaded. So I go ahead to present the balance sheet. And in our previous video, we are presenting a balance sheet, or it is called under IFRS, statement of financial position. But under group, we call it statement of consolidated financial position. So for you to present a balance sheet of financial position, you have to first of all write the name. There are two companies before the acquisition. You have Kola and you have Tola, the parent company. You have Tola, the subsidiary company. Now you are having only one company. Which company? The company that acquire another company. Which company acquired the other company? That is Tola. So you are going to have a Tola PSC. What is the name of the account that we are presenting? Statement of consolidated financial position as at 31st May 2022. 31st May 2022. So let me underline. So instead of us having two financial positions of Tola and Kola, we only have only one. And that is the heading. Tola PSC. And we have assets. We have asset, which is non-current asset. Non-current asset, which is we add it together. We add 1,800,000 plus 700,000. 1,800,000 plus $700,000, and that gives me 2,500,000. So no Goodwill, because Goodwill The goodwill is what is negative goodwill. So goodwill, negative goodwill. Negative goodwill. So it will be treated as this is name because it is negative goodwill. Even it's positive goodwill to be added because goodwill what is an intangible asset. Okay, we go to current assets. Current asset. So, current assets, we have inventory. Not current assets. What is current asset? Current assets are what? Are the assets that bring future income into the company within 1 year. While non-current assets are the assets that bring future income to the company more than 1 year. Maybe 3 years, maybe 2 years, maybe 5 years. Because non-current assets are what? Are like motor vehicle, equipment, premises, land and buildings, and so on and so forth. So, but inventory is a current asset, which is what? Those are goods. Inventory are what? Are goods. Bracket goods. This means the assets that the parent company deals with on day-to-day activities. Maybe the company is into pure water, into bottled water. Maybe it's into plastic sales. Maybe it's into books. It's into maybe raw material. It's into phone. It's into stationery. Just any goods that the company is selling day to day, every day, everyday business. So the inventory here is when it's added together, both the parent company and subsidiary is giving $1,750,000. You had $950,000 and $800,000 together. I give you $1,750,000. Then we go to trade receivables. What is trade receivable? Trade receivables is the amount that the company is to receive in the future when it's so good to its customer. The money that it has not collected is what we call receivable, which is able to receive in the future. Another name for it is what? Is debtors. Another name for this is what? Is stock. Okay, stock. Just leave it this way. That is stock. Inventory, that is goods. Then another name for it what? Is stock. The another name for trade receivable is what? Is debtor. Before IRS, it is debtor. When IRS, since the invention or the beginning of the IFRS, debtor is being called trade receivable, while stock is being called inventory. Stock is being called inventory. So what is the amount for trade receivables? And that is 1,400,000 plus 1,300,000, and that gives 2,700,000. 700,000. So we have a bank. So you have bank. What is bank? Bank is what is the money that the parent company have together. Both the parent company and subsidiary, it is being added together, and that's been a consolidation. And that is 1,300,000 plus 1,150,000. That gives me 2,450,000. 2,450,000. So you add it up. This is total asset, and that gives me 9,400,000. So you balance it up there, and this total asset. Total asset. Then we go to equity and liability. Equity and the liabilities. And equity now. We have equity. You have equity, which is 50 cents each. And in this case, it is only the parent company equity, which is $800,000. $800,000. Also, you have the share premium. Share premium. Only the parent. Okay. This is a parent company only. Parent company only. Also, for share premium, parent company only. And what is that figure? If you go to balance sheet, go to statement of financial position, what is that figure? $600,000. $100,000. Then you go to retained earning. Retained earning. This is a consolidated retained earning. Consolidated retained earning. And this is what? This is working, that's a working free. Or which working is it? Consolidated earning is a that should be working 4 there. That should be working 4. Consolidated earning. That is working 4, which I rub off working 4. And what is that? That is a 2,900,000 in that working. 2,900,000. 2,900,000. Yeah, you add it up. Right? Add it up. And give rise to 4,300,000. Then you go to equity and liability. Goodwill, it's negative goodwill. So we go to under equity and liability. This is equity. Then remain what? Liabilities. And you have non-current liabilities. Non-current liabilities, which is a 50% loan note, 15% loan note, 15% loan notes. This is consolidation. You add this parent company and subsidiaries together. Parent company is 1 million, while subsidiary is what? Is 800. That gives $1,800,000. Then you have a current liability. Current liabilities. And number one on the item is trade payable. What is trade payable? Trade payable is the goods which the supplier supply to the companies which they have not paid for. That's a trade payable. That's another word for it is creditors. They have been they have money to pay to what? To those who supply them goods. Those who supply them goods. And that's what trade payables. So that is also consolidation. You add the parent company and subsidiary together, and that gives parent company is 1,250,000, while subsidiary is 1,150,000. Total of that is $2,400,000. So you also have what is that? Bank overdraft. That also is also current liability. Bank overdraft. Current liability means what? Amount that the company is supposed to pay to outsider within 1 year. While non-current liability is what? Amount that the parent company is supposed to pay to outsider more than 1 year, maybe between 1 to 2 years, 1 to 3 years, 1 to 4 years, or 1 year to 5 years and above. That's what we call what? They are not current. They are long term. While short terms is what is current liability. So you have bank overdraft there. Bank overdraft, which is, what is that amount? For the parent company, 600, for subsidiary, 300. So when added together, it gives $900,000. $900,000. So you balance it off, and total gives, you add all this together, it gives 9,400,000. You can see this is the assets equal equity plus liability. The total of this gives us 9,400,000. So that's about the statement of consolidated financial position. This is consolidation. In the balance sheet that we have for the question, we have two columns, but this is single column now. This is for Toller PLC. Toller PLC, we have consolidated the two columns together. This is meaning of consolidation. So all along, we have been deriving value for the group account. This is what we call group accounts. This is what we call group account consolidation. So we consolidate collar, and collar PSC together. And this is what? This figure. Asset equal equity plus liability. It must be equal. That's the balance sheet. So don't forget again to subscribe to our channel. That shows that you are supporting us to produce more of this in the future. When we see more subscribers, we'll be encouraged to produce more of this, and we see increase in the analysis of the watch hour. We'll be encouraged to produce more. So do continue to share and subscribe to our channel. We continue to give more of this in the future. Thank you for doing that. See you in the next video.